Hi everyone, Jackie DiMonte. My presentation today is going to kind of focus around just the fundraising process and how we look about it, how we look at it from a VC perspective, and how that kind of correlates to what you would see as entrepreneurs. So kind of a quick baseline in the room. How many folks here are working on a startup or employed by a startup and kind of are familiar with the... Awesome, cool. So we'll kind of walk through, either some of you might have had an experience going through this or are coming up on one of these fundraising processes. So hopefully it gives you a little bit of a look on what we do kind of on the other side of things throughout the whole process. So as we start, a little bit about me. So went to U of I, engineer, did not do anything strictly engineering after that. Went and worked for Accenture, so pretty much a tech consulting firm. I worked on a lot of M&A, so ERP, so that's enterprise resource planning, so enterprise software consolidations, and then helped advise companies on when cloud was a new thing for HR, finance, all these different back office systems, how they chose vendors and actually moved from legacy on-premise solutions into cloud vendors. I also go to Booth part-time, so I've been going for about 3 years and finished up this year. And then, through that process, started working at a company called Silver Spring Network. So, folks familiar with IoT in general, Internet of Things, some nods. Okay, so that's connected devices. And what Silver Spring did was, or does, makes chips that go into different devices, the network that those chips connect to, and then the back-end software to kind of manage and gain insights from the end devices. So the company was built off of the utility industry. So if you think about the smart grid, those typically have Silver Spring chips in them. My job was taking that same core technology and moving it into the smart city space. So you can think about the reliability, the security, the safety of the network is very much applicable to any sort of lighting assets, parking, things like that, kind of the critical infrastructure. So had a lot of experience kind of just mashing different products together. Before I came to Hyde Park, and I'm on the investment team there. So a little bit about Hyde Park and kind of what we do. So this is our second fund, $65 million fund. We do early stage investing across the Midwest and then some other areas that are Midwest-like. And so what that really means is seed and Series A companies, companies early revenue up to about $3 million a year in annualized revenue, and we'll write checks of anywhere from $100,000 up to $2 million. And so really, we focus on that early stage, and that's where a lot of the conversation is gonna be based around today. And then me specifically, Jackson kind of alluded to this. I do a lot of our sourcing work, so finding the companies to invest in, kind of being that first filter. Doing the deal work as well, so when a company actually has that first meeting and continues on through the process, working hand in hand with entrepreneurs. Do some portfolio management, so helping with our venture capital value add, things like this, so brand building, community building, different things, and then reporting, which is always fun. We just went through our annual reporting cycle, and so had a lot of fun with the audit. We'll focus today on sourcing and deal work because that's the process that most of you will be involved with or have your first exposure to VCs. So everyone kind of familiar with where VCs kind of play, what businesses are built for venture capital funding? Maybe. I think you guys had some VCs in here for the last one, so I'll kind of be a little bit more brief about this, but I really like this. This is, I'm forgetting the name. But an Inc. article about kind of what companies are really suited for venture capital. So in the Midwest, a lot of times we think about B2B SaaS companies. So any company where you need a lot of capital up front to build the product before the revenue starts coming in. So that would be, right, a lot of capital required to sell something and break even with high scalability. Because once you build the core product, you can sell it over and over and over again, very scalable product. You see this in other things like social media companies, so a lot of consumer apps, or even some food and beverage companies would be another example, not in the software space, where the R&D, the initial working capital to get inventory, that requires capital up front, and you don't see that until the product's actually sold later. So focusing on venture capital. I'm going to stop at each one of these slides just to see if there's questions. So I'll do a brief pause and we'll move on. And the other question then is when do I actually go out and raise venture capital? So I stole this graphic as well. I'm not taking credit for it, but if you think about this early part where you're cash flow negative, right? You're deploying capital to build your product, and there's no revenue coming in the door. A lot of times, the people that are going to be funding you then are these angel investors. So whether that's friends and families, and that really means your network, anyone that you know or that who you know knows, and then general angel groups. Those are the folks that are going to be investing in you because they believe in you and they think that you're going to get somewhere later, right? Venture capitalists might not know you personally, and so that information asymmetry makes it a hard leap to invest in you at that very early stage when it's just an idea or a PowerPoint or something similar. Venture capitalists get involved, right when you're starting to grow, and then you will see growth investors after break even to help accelerate the growth. And then once you get into later stage companies, it's either public markets, private equity, M&A, all that kind of stuff. So what we want to do as venture capitalists is invest right here, right? So right before there's an inflection point, you want to deploy as much capital as you can. The company uses that and turns it into an acceleration of building sales, all of that other kind of good stuff. Questions there? Okay. Now I'm going to kind of switch a little bit into the actual process of raising venture capital and kind of walk through what we do from our side for each one of these stages, and then I think what is a little bit more readily available too is what entrepreneurs can do from their side to keep moving things along. So the first thing to talk about is kind of how you get the first meeting, right? Because that's ultimately where it starts. And different firms have different philosophies on how they find companies or how companies find them. At Hyde Park, we actually think it's very important to meet every entrepreneur we can in our geography and doing kind of software technology. And so we do I'm sorry, I'm standing right in front of this, but we do actually a lot of outbound sourcing, and so that's what falls into this category of we'll read press releases and see who's working at ZWorks, look and see who sounds interesting, who's at the right stage, and reach out to them and ask, are you willing to meet? You want to have a quick phone call, something like that. On the far other side of things, when you're reaching out to find VCs, if you don't have them reaching out to you or someone else facilitating an intro, there's things like mentoring sessions, there's curated matchmaking, so any sort of programming where it's, meet a VC, and then kind of your last resort is just the cold email, right? You get your target list, you look at who in the fund is most likely to be interested in your company. So if it was me and you were an IoT company, you'd reach out to me. If you were a ag tech company, you would look at Guy, right? So you kind of align interests and funds when you're looking at things. And then kind of the best scenario is getting an introduction from one of these people. Did you have a question? Oh, no, sorry. So if you can get an introduction from other entrepreneurs, especially respected entrepreneurs in the fund's portfolio company, that's a very positive thing. You'll get the meeting every time. Or other investors. And so that could be even better if it's your current investor. So someone who says, look, we just did their seed round, or maybe not just. A year ago we did our seed round. We're really excited about the company. You should take a look, right? That's a very credible thing. Or if it's a VC that's leading your current round and they introduce you, that's also a kind of a fast track through. And then finally, in any of these scenarios, whether you're asking these people to make the intro or they're reaching out on their own, and then of course if you're doing your cold email, think about fit. And we'll talk a little bit more about what that means, but kind of spamming a lot of people for meetings can end up wasting a lot of your time and other people's time. So when you think about what stage you are, what sector, things like that, you want to be cognizant of, is the meeting worth my time, my 30 minutes, and is it worth someone else's? And I think that goes both ways. Questions yet? Okay. I'm speeding right through.
Curious, between people contacting the venture firm
Yep.
versus us contacting them, what sort of breakdown is it in terms of percentage of companies that would reach out to us versus a venture fund reaching out to the company?
Yeah, so I think for Hyde Park specifically, it's definitely a minority for us reaching out. I think at least for the deals we do. And it depends on the fund's philosophy and the fund's brand. So if there are venture funds with very high standing, everyone wants to take their money, they probably don't do as much outbound because everyone's already coming to them. Versus if you think about Hyde Park in our first fund, didn't have as strong of a brand, so it was more hustle on our part to say, how do we find these people because no one knew about us to reach out for. So it varies based on the fund and their brand, how active they are, things like that, and even their philosophy in sourcing. Makes sense? Yep.
Typically the interest of the startup, it's better to go with VC firms who are actually in their space who can help them propel to that growth stage rather than just somebody who's giving them money.
Is that a question or a statement?
It's a comment that I think, is that valid?
Yeah, so I think there's two pieces to that. One is getting the deal actually done. If you're a strong company, it's more likely that someone who understands that you're a strong company will do the deal. So for example, I would never lead an investment in a marketing tech deal because I don't know the space that well, right? Versus someone like Tim, one of our partners, knows the space extremely well, and so he would be more likely to move it along. So that's getting to the deal. From the entrepreneur's perspective, you want someone who not just can do like the value add stuff, because you might have minority investors that aren't as active on the value add and you just want to fill it around, but you do want to make sure that they understand how your business works and how your sector works. So if you think about an extreme example would be a consumer-focused VC investing in a healthcare IT company where things move really, really quickly and you're adding a ton of users a month in the consumer side versus the sales cycle taking 9, 12, 18 months on the healthcare IT side. You're going to be talking to that healthcare IT company and saying, like, what's going on? Why don't we have more revenue? What is this? And so from that perspective, you want to manage your investors and their expectations adequately, and it just makes it easier if they get the space. They can both be more helpful, but then also less harmful as well. Yeah.
So you mentioned philosophy, kind of under the hood kind of thing, not so much the giving of money, but the philosophy of communication. Can you speak more towards that? If it's good, you mentioned Tim. I think Tim Kopp is probably what you mentioned. Let's say the philosophy is that Tim Kopp communicates a certain way, and the marketing or marketing tech company communicates in another way. How do you match those philosophies after you initially believe in giving the money versus the communication, the philosophy skills, trying to move together to make more money?
Okay, so let me figure out where in the process. So are you talking about getting to the point of the term sheet, or
when the negotiate the deal is almost there?
Yep.
What is the communication of? You mentioned philosophy, just with the matching. What does that entail? Does that more entail communication? What are kind of the facets within that?
Within philosophy.
Yeah, within the philosophy of you mentioned that like what you invest in, what you believe in to scale that, but also the communication point between the VC firm and the entrepreneur, the company.
Yeah, I'm trying to understand. So I think when I referred to philosophy before, it was about how we were finding companies in that initial engagement. Communication styles, once you are at the point of investment, it becomes much more personal in that the person who is highly involved in the deal is going to stay highly involved. So if you were to work with Tim, you'd probably talk to Tim and your philosophies would align because he fell in love with you and wanted to invest in your company, right? And so he would pull us in as we could be helpful, but you wouldn't automatically get a bunch of questions from other people on the team after the investment happens.
Okay.
Is that kind of helpful?
Yeah, that answers. Yeah.
Okay, cool. Sorry if it took me a while to get there. Yeah.
to when a new company comes into your area of vision,
Yeah.
what are the top 3 things that you look at?
Sure, I will talk about that right now. Oh, yeah, sorry.
Actually, I mean, this is my first meeting in baptism by water, so to speak. I'm getting a little lost just with the questions itself. I'm feeling a little overwhelmed. You're doing an excellent job of communicating, by the way. I'd
Thank
like
you.
to ask questions, but I'd like to defer to the end if that's possible for us all, because I mean, this is a lot to take in a good way.
Yeah, we'll have time for Q&A
Unless
at the
you
end.
choose this way.
So we'll continue doing it this way, but my presentation is not that long, so there will be time at the end for Q&A as well.
Thank
Yep.
you.
Yep. So talking about kind of like the top 3 things. When you look at this applies in both of these next 2 slides that I have are going to apply both to how you initially decide who to meet with, but then also in the meeting, so you can take that from the same lens. But when you think about that first meeting or that first outreach, it is a lot about getting to know each other, especially in the early stage. It's a lot about a people-to-people business, and so there is a lot of soft stuff that I'm not covering right now and kind of being very black and white about. But kind of the first thing that we look at is just purely what is your business model? What are you selling? And so for Hyde Park, if you're a medical device, we're going to say, this is not really the right kind of company for us. If it's a B2B software company, we really are excited because that's something that's squarely in our vision. If you're a marketplace company, we do invest in that, but we tend to be a little bit more selective, and similarly with consumer. But if it's software, we're going to take a look, that kind of thing. And so that's one of the first qualifications that we think about. The other thing that I ask always is kind of like, what is your traction, right? And some people who aren't used to fundraising or the first kind of calls that you take will be a little bit taken aback by this of you're asking me for my revenue and we kind of just started talking, but it's a very clean way to qualify kind of where you fit in our investment thesis. So I mentioned earlier that we do both seed and Series A, and so if you're a company that's doing $10,000 to $15,000 a month versus a company that's doing $1 to $1.5 million a year versus a company that's doing $10 million a year, I can figure out, are you a seed company? Are you a Series A company? Are you way far past us, right? And so it's helpful to be able to gauge how do you actually think about where you fit in our universe. And then also fundraising, right? So are you fundraising? Are you going to be fundraising? What are your thoughts about that? Because it helps understand like what are the next steps that we're going to take. If you're fundraising right now, awesome. Let's continue the conversation. If you're like we have a term sheet we're going to close tomorrow, my reaction is going to be like, I don't know if we can move that fast. And if you're like, well, we've got enough runway, for a while, then maybe you set up more time. But that's another qualification to say, kind of like, what are the next steps and how fast do we have to move on both sides? Make sense? So those are kind of like the 3 that I put together of what we think about. From the other side, not everyone does this. At Hyde Park, we like to kind of start the call with an introduction of these are our modes of investing. This is kind of where we play, so that everyone's up front on the same side, and then open it up to questions from the other person on the phone. But when you think about that, as an entrepreneur, when you're talking to a VC, you should get the information that you need from them as well. So if you think about and I'm calling this the thesis, but it's generally just the mantra or the focus area of the firm. So what kind of sector do you invest in? Business models, technology, geography, all of these things to say, are we someone who could be a fit for you? Because if we're not, I don't want to waste my time talking to you anymore, right? And so when you think about it, and even when you're building that target list, you want to say, are you a technology investor and am I a technology company? How closely do we align? And even when you start to think about kicking off your fundraise and where you kind of place folks in your fundraising time, maybe you do your first couple calls where you kind of fit in their thesis, but not a whole lot. So it's sort of a practice call, right? You're like, it's good enough that we have the conversation, but you're probably not going to be the one to jump on me. So maybe we front load those VCs or things like that. Then the other thing to talk about, and this one's just very clear or very clean, is what stage are you comfortable with, right? Are you comfortable with pre-revenue companies? Are you comfortable with, do you have kind of traction metrics that you look for. Do you do seed, Series A? Are you a growth investor? Things like that. And then finally, what are the fund dynamics? So this is something that this is a question that I don't get as much from entrepreneurs, but I think it is an important one to think about. So this is where I'll kind of pause really quick and ask how familiar folks are with venture capital. So does everyone understand kind of timelines and horizons for venture?
Let's do a little primer on that.
Cool. So let me start. I'll back up a little bit, and if everyone already, or if a few folks already know this, apologize for the review. But the way a venture fund is set up, we raise a bunch of money from other people. They're called our limited partners. We're the general partners that deploy the capital. And what happens is, when someone commits money to our fund, we actually call that in over time. So we don't actually, we're a $65 million fund. We don't have $65 million sitting in a bank account right now, right? We have some that we can use to deploy, but as soon as we get low on that, then we'll ask for more money to deploy. And so venture funds, and the exact timelines are different depending on the fund you are, but the first couple of years, you're deploying capital, and then the last couple of years, you're following on to the investments you made, and then hopefully companies are exiting, and you're returning more than you actually deployed in the first place. With me so far? So when you think about fund dynamics and how far you are into the fund, in the beginning of the fund you have a lot of capital to deploy and you're a little bit more flexible. And you have kind of this long horizon before an exit is expected. If you think about maybe being 5 years into the fund, there's a shorter time period until when the natural endpoint of the fund is, and so funds tend to invest maybe a little bit later stage as they get towards the end of their fund, right? So you just want to be aware of kind of what are you guys thinking? Have you already committed a lot? How easily am I going to be able to get your investment? How long do you have before you kind of want to turn around, right? And so those sorts of things you want to think about. And then also how big the fund is, right? So our first check that we would write to a Series A company could be $1 to $2 million. Our fund is $65 million, right? And so we actually have a lot more capital to follow on with the companies that need to raise more money later, right? So if you start to think about if there's a fund that's a $10 million fund and they're writing a $1 million check, that's probably the only money you're going to get from that fund, right? Because they're probably going to invest in a handful of companies, and that'll be that. So you want to start to think about some of those dynamics of not just for this round, but how helpful can my VC be as we move forward, right? And so some of those good questions to kind of put them on the spot a little bit is a good thing to ask and kind of qualify to. That was a lot. Do I need to rewind and do any of those pieces over again? Any questions? Yeah.
I do have a question. So you said that the funds are usually LLCs. So when they invest in your company, what kind of a company do they want you to be? Or do they want you to also be an S Corp, a C Corp? Do they want to be a part, one of your LLC members? How do they?
Yeah. So actually, I'm not very good on legal. I didn't say. I mean, I think we are. I will be upfront. I'm not good on legal, so I didn't say LLC. But we don't invest typically in LLCs. The structure doesn't work. So otherwise, there's a lot of resources online. I can look up and go back and tell you about it later.
Okay.
Yeah. Anything else? Cool. So then, if we think about this kind of being the first meeting, all first meetings should end kind of with next steps, right? And these next steps can range from no next steps down to, okay, we're ready to invest, which is very unlikely, but you kind of get the whole gamut of next steps. And so what I'm going to walk through right now is kind of what I see typically, the buckets I see of how we end our meetings, and then what you should do or what the VC should do coming out of that. Make sense? So the first one is you're just not a fit. That's it. We're kind of done talking, right? So, I'll give you an example. There was a CPG company, in a accelerator that I met with that I loved the entrepreneur, loved the traction, all this other kind of stuff. But we just don't invest in consumer products, right? So as that entrepreneur, if you have a connection with the VC, but they're not going to invest, what do? You ask for intros, right? So who do you know that also invests in CPG, or who would do, e-commerce or whatever type of business you are, and then follow up on that. So I will, and I know a lot of other VCs that do this just because you get busy and meet with a lot of companies. I will often forget to make an intro unless the follow-up email is sent. I love inbox zero, so I will make that intro just to get rid of your email. But make sure you follow up when you have those sorts of conversations, and always ask, because even if someone only slightly knows someone or knows of a fund, that's a little bit more of a piece of information than you had before, or at least you can start to see patterns over time. So an example could be, even if I know there's a fund that does e-commerce, but I don't really know anyone that well at that fund, I can say, look, I'm not really comfortable making the intro, but you should talk to someone at that fund. Then you can go on LinkedIn, see who you're connected to, or in your next VC meeting, say, hey, do you know anyone at this fund? Because I think they'd be good to talk to. And you start to build that track record off of it. Okay, so that's what happens when there's no chance of an investment. Yep.
What percentage of no further steps is because your domains don't match?
There's quite a few.
Can you repeat the question?
Sure. So how many of the not a fit is because our domains don't match? I would say the majority of the full stop not a fit is because the domain doesn't match, or you're too far along for us. I do meet with some companies that are doing $5 million a year, and I'm just like, you're raising too much, your valuation's gonna be too high, we just can't support you. So those tend to be a little bit more black and white issues. The no, not for now tends to be a larger percentage of companies. So this would be your pre-revenue. I like your idea, but I'm not sure about it, so I'm not gonna fast track things along. But I think we should probably talk when you have a little bit of traction and a little bit of a proof record that says, you know what, there is some product market fit, people want your solution, and there's some more around that. In that case, you should pressure the VC for either a specific time or put it on your calendar to follow up. We do see a lot of companies, and the ones that we're really excited about, we will put reminders on the calendar for. You also meet with, say, a half a dozen companies a day, and you might forget. And so having your own kind of CRM or VC tracking tool of, this is who I reached out to, this is the answer, this is when I should follow up, can be very helpful. Excuse me. I also know people that we kind of put on this list and we track over time will also send us occasional updates. Those don't really, they're not any extra burden necessarily for an entrepreneur, because it's something that you might send out to existing investors anyway, but it keeps you top of mind from a VC perspective. So if anyone's ever gone through an accelerator, a lot of times they coach you to send out weekly, monthly, quarterly update emails to your investors or potential investors. And that's usually just, here's how we're doing, here are the highlights, here are the lowlights, this is the kind of help we need, let us know if you want to talk, that kind of thing. And so when you get those and all of a sudden someone's starting to blow up, it prompts that outreach of saying, hey, can we talk again? So it's all about just kind of staying relevant and showing that you're progressing, so that when it gets to that part where you are in the hit zone, right, that everyone's familiar and kind of ready to hit the ground running. Make sense? Yeah.
Do you ever get annoyed by those emails?
All the time.
Because we talked, for our situation
Yep.
personally, we just talked to a partner or employee of yours, Eric Weisberg, I think.
Oh, Hyde Park Angels.
Yeah. Okay,
Yes.
so different.
Yep.
But anyway, I think we probably fall into that, just not now.
Yep.
And it's kind of hard to tell, on a month-to-month basis. Certain months it's awesome and there's a lot to
Yep.
tell, and others it's like, not
So-
a whole lot going on.
Yeah.
So would you like to get those monthly anyway, or?
I would say for when you're in an accelerator program, the monthly, like they just coach you to do that.
Right.
The issue with that from a VC perspective, and I know this was a little unclear, so thanks for asking the question. From the VC perspective, I feel like it's not enough time to see the change happen. So what I would say is, don't do it just before your next fundraise, but do it maybe quarterly, or just kind of a check-in. If I get them too often, I kind of just send them straight into a folder, right? So that 3 months from now, I'll actually, look at it and assess the progress. But we actually do keep track of our companies over time, so that update email you sent me 3 months ago, and then the one that you sent me today, we have them all. So we can kind of track that over time, so that when the conversation happens, we're like, whoa, they were doing nothing 6 months ago, then 10,000 3 months ago, and now they're doing 65. Like, holy cow, that's actually a nice track record. So the exact cadence is kind of difficult, but it is nice to have that kind of outreach. And then every 6 months, just kind of personalized email, or year, whatever the right cadence is, to say, hey, we have an update on our fundraising. Do you want to talk? Yeah.
A question about the domain fit. So, like my startup is a two-sided market, and
Mhm.
so one side is B2B, and the other is B2C. So if I do my due diligence and somebody does B2B, but not B2C, should I still send something to them, or like what do you recommend
So
there?
there are. I mean, I think with a B and a C on each side of the marketplace, I think you still do qualify as a B2B marketplace, right? And a lot of, I mean, even if you think about any marketing company ever that is selling to companies that sell to consumers, right? It's a similar type of thing where if one side is kind of like that enterprisey sale, it makes sense. Also, just look at their portfolio. If they do a lot of marketplaces and they understand marketplaces, they're probably prime examples. Okay. Thought I saw a hand. The next step is circle back with next steps. So this is something that I say when I don't know a lot about the type of company that I'm talking to. And so, what's an example? Let's say you are a AI for solving cancer, okay? I know nothing about the cancer space, and I might know about AI, but let's focus on the market, right? So like super, super deep healthcare tech. I don't necessarily know how to evaluate that business idea, especially if there's not traction. So if it's a seed stage company, I can't tell if customers want it or not. I can't tell if things are working or not. I just need to know if the actual idea is interesting. I'm going to say, I'll come back to you next week with next steps. Are we going to set up another call, or is it not a fit? And what that really means is we're going to go back to the Monday meeting. So we have a 2-hour-long meeting where we discuss all the people we met with and all the people we think are excited or have questions about. And you bring it back and you say, all right, this is the idea, this is the entrepreneur, this is what they're doing. Is anyone interested in having that second call? And so you're really bringing the idea to someone who is a domain expert to get their opinion on yes or wait for now, that kind of thing. And so typically when that happens, if you don't hear from someone by that Monday or Tuesday, you should just send a quick note and say, like, what's going on? How is the partner meeting? But that's typically what that means, is we have to discuss internally because I just don't know enough about you right now to decide anything concretely. That makes sense? You never want to say no to a company that you don't know if it's a yes or no. And so that's sometimes why you get left, hanging on, in those situations. Okay? The next one is meeting in a few months. So this is kind of a better version of the just not now. So if there's someone I'm really, really excited about and it's just totally not a fit for stage, I'll say, let's put something on the calendar for 6 months. And someone just throws a meeting invitation on the calendar, and if it gets close and you have to adjust it, then you adjust it. But either the VC should send an invite, or you should check and make sure that the invite was sent, and follow up and say, are we talking in 6 months? Because we should put something on the calendar. And that's just kind of a way to say, look, I'm really excited. We should not let this fall off our radar, and let's have kind of an update conversation later. Cool? Then kind of the best case scenario for most scenarios is, let's set up a meeting later this week or next week. And so typically our process at Hyde Park, and this happens I think for a lot of times when it's an individual meeting with a company, is let's get you introduced to more folks on the team, because if we move this forward, you kind of want the backing of everyone on the team as we go forward, right? And there's typically multiple people working on any deal, because there's people doing diligence, keeping in touch with you as an entrepreneur. There's a lot of moving parts. And so we go from kind of that first intro phone call to let's get more people in the room, and you might have to do the whole spiel over again. But it's a way to move things forward within the team. And then finally, if someone commits, just say okay and move on. I've seen this happen very few times, and only in very early stage companies where the check size is very small and you've kind of known the person for a while. Any questions? Cool.
Oh,
Oh,
you're
yep.
talking about, you're not finished yet, correct?
No.
Okay.
I have one more slide.
All right, perfect. No,
Okay.
I want to wait.
All right. So I think that was a deep dive into kind of like what that first meeting is going to look like. I'll do a quick, and I can do this kind of quickly, but review of kind of what our process is and kind of what you probably see as entrepreneurs, so that you know what's happening, underneath the surface of everything. And so we can go as quickly as we want through this if everyone knows all of these. So what are kind of all the steps? You have, we covered the first meeting, and then we kind of talked a little bit about this. The new company is introduced to the rest of the team. This is typically on Mondays. Sometimes it's more fluid than that, but basically you come back and say, I just met this awesome team. I'm really excited about it. Here's what they do. Here's who I met with, right? So that everyone starts to see what's going on. Yep.
And when you go in for your first meeting, do you go in with a business plan and a pitch deck?
That's a great question. Business plans are hard just because it's a lot of words. Pitch decks are awesome. I would always send the pitch deck ahead of time if you can. And whether it's a full 24 hours in advance and then maybe an hour before, but if you send the pitch deck in advance, someone can at least have those intelligent questions ready for you and aren't scanning slides as you're talking. So going to the first meeting, pitch deck, if a VC is reaching out to you and you're not fundraising, it's okay to come in with nothing. So there's plenty of entrepreneurs where I've been like, hey, can we have a quick phone call? They say yes, they're not fundraising, they won't be for another year or so, so there aren't really any materials to talk through, and that's where the conversation is a little bit more fluid, where it's more on your background, how you got the idea, how you started the company, where you're at, and it kind of flows historically, if that makes sense. Okay. So once everyone on the venture team learns about your team, that's when the second call happens. And just so this is clear, this is kind of like what's on surface level, and then kind of this swim lane is what's happening under the surface. So the second call is typically, a shortened version of the first call, and then digging in a little bit deeper. Then diligence starts to happen. And so typically, because as VCs, you want to be cognizant of an entrepreneur's time, right? Like there's a lot of other things you're doing, and you don't need to be wasting your time with us if we're not going to at least take a very serious look at the company. So this first part of diligence is what we call bench diligence. So it's anything you can look up online, anything you can get to by talking to your immediate network. If it's a consumer deal, maybe demoing the product. So there's a lot of things that you can do internally and what we kind of call bench research before taking up any more of the company's time. So if there's kind of a lag in time after the second call, but before something else happens, that's usually internal work to say, is the market size big enough? Are there enough customers? Kind of what's going on from that perspective. Yep.
If there is something proprietary about something that's happening, is it okay to ask for an NDA?
So from the venture side, or what's proprietary on your side?
On my side?
So it's very, very rare that a VC will sign an NDA because you see so many ideas that it would be hard. You know, you might have something proprietary, and another person doing a very similar thing in Chicago might have something proprietary, and so signing something with you and not being able to talk to them, it's just a very complicated thing because of the volume of companies you meet with. So where an NDA sometimes gets more relevant is when you go into deep diligence, right? So like first, second call NDA, everyone's gonna be like, just share the stuff you're comfortable sharing with us. Don't do a deep dive into the tech. Don't do anything that you feel is behind that wall. Talk about your team, talk about the progress, whatever else. Then once you get kind of into that deep dive, that's when you start to talk about, like what kind of documentation you need. So kind of stepping back to once we get through those kind of initial check marks of did we do our diligence, that's when you'll probably hear from the VC saying, all right, these are the key questions we have, so this is the material we want from you. That can be anything from your past financial statements, your current customer list, your pipeline, your forecasts, product demos. There's a whole list of things. But really what, especially at the early stage you're trying to get at is what are the key questions about this business, and how do we, basically get those answers as quickly as possible. And by quickly I just mean with the least amount of tax on your time and on our time. So there's probably a more limited set of diligence materials that are requested from entrepreneurs. Now something on that, a lot of times we say like don't put anything together that you don't already have or can't quickly shuffle through. And so I think there's a nice little balance of that where you try to provide the information, but it doesn't have to be super pretty. But if you come back with kind of just a commentary on, we've got like 9 customers in our pipeline and they're worth $3 million, folks are going to be kind of, like, all right, well, that doesn't help us much. Raw export out of your CRM, super easy to deal with. So there's kind of varying levels. So I would be clear on what kind of the intent is from the diligence request, and if you can kind of get a proxy for that without spending a lot of time putting materials together. Make sense? Then we kind of do our analysis on those materials. Nothing really surprising. So once you kind of get to that part, and this is both diligence on the materials and then also more of the customer calls or our own network calls to make sure we're understanding the business right. We do what's called like a full partnership pitch, and various companies have different policies on this. So at Hyde Park, if we're writing a large check, we want to meet the entrepreneur in person. That seems very like it should be standard, but for smaller checks, only a couple people on the team have to actually meet the entrepreneur. So it does vary even within our firm. Some other firms you have to meet everyone all the time, and it's much later in the process, but typically there's kind of that final pitch. And what I mean by pitch there is it can be 3 hours of diving deep into the business. So this isn't the high level, here's who we are, this is what we do, and this is more of a, the VC will send a set of an agenda ahead of time and say these are the topics we want to dig into, so that you're kind of prepared for like what we really want to get out of the meeting to be able to make that yes or no decision. Make sense? Sorry, I keep checking in, but I want to make sure I'm not moving too quickly. And then from the partnership pitch, we go into investment committee, and that's basically where the person or people leading the deal, so the one that you've been communicating with the most, will put together a set of materials that say, look, I really want to invest in this company. I believe in them. I love the entrepreneur. I think this company can be great. And they give all the reasons why, and then highlight all of kind of their key risks and whether or not those are large enough concerns to overcome kind of the infatuation with the entrepreneur and the company. And then, from that point, and different firms do this different ways too. Some firms take votes. Some people need unanimous votes, so every partner needs to agree. Some need a majority. Some only need one person to really spearhead it. And so some of those voting dynamics can get interesting. But typically coming out of that investment committee meeting, generally whether it's a yes or a no, and then typically kind of a range for the check size and valuation and things like that. Then if you are the VC that's leading the round, and everyone understand the dynamics of leading versus participating? Okay, some nods. I'll do a quick rundown. So if a venture capitalist is leading the round, it means they're negotiating the terms with you and putting forth the term sheet. Okay, so at Hyde Park, we can lead a round that's a $3 million round with a $1 million check, right? So we put out a term sheet that says, we will commit $1 million in a round of 2.5 to 3 with this valuation and these different, legal terms. The entrepreneur will say yes, no, probably negotiate it, but then once that term sheet is signed, all the other VCs that are going to participate or angels would then invest off of those terms. So they would fill out that round and you wouldn't have different kind of legal documents for those various other parties. Does that make sense? Okay. So that's where the term sheet comes from. This would not exist if you weren't leading the round. People would just say yes or no to the terms that were set forth. There's final diligence for very large investments. People will kind of dig in deeper. And to your point about an NDA, this is kind of when you're like, we're going to make this investment. Let's do a deep tech dive, right? And make sure the tech is what you say it is, or something like that, as an example. And then finally would be legal docs. So the term sheet is typically 1 or 2 pages with very layman's terms, and then the legal docs end up being 100 pages of kind of, not crap, but a lot to read through. Then finally, right, hockey stick, and you start setting yourself up for the next round. Any questions? Because that's almost the final slide. Yeah?
So what's the advantage or disadvantage of asking for a big round up front so you don't end up needing additional rounds versus taking what you need now for the next 1 or 2 years and go back again for another 2 years?
Yeah, so put very tactically, it's valuation. So if you think about raising $2 million right now to get you through the next 18 months and then $3 million after that, your company is worth a lot less right now than hopefully it will be in 18 months, right? So that the valuation is going to be lower and you'll be diluted more. So if you took $5 million right now, your company might only be worth $5 million, and then you're giving up half of your company. Versus if you take $2 million right now, man, I'm really bad at this math, but 2/7 of your company is being given up, and then as you bring it forward and you've grown, maybe your company is now with 20 million, and so then that extra 3 million isn't diluting you as much. That's just like a super tactical way of thinking about it. There's also some psychological reasons of like spending more or being able to, make it last, things like that, but that's kind of the basic rule of thumb.
So in that case, is it a good idea to try to find a venture fund that you think might be in it with you for the longer haul, or is capable of being in with you for the longer haul, rather than closing out with this venture fund and then looking for a whole new company, or what do you think?
Yeah, so typically, so you want someone who can support you. Mm-hmm. At the same time, if someone's gonna give you money in your super early stage, there aren't very many super early stage investors that can support you for that long. But if you think about the way venture funds invest, right? We focus on seed and Series A. We can't write a $6 million check, and there are venture funds that just solely focus on writing $5 to $10 million checks, right? Because that's the economics of their firm, and so you really won't find too many funds that will support you all the way through. Now, what will happen is folks will have reserves, and so those reserves can be used for 2 things. So if our first check-in is $2 million and we reserve, I'm going to make this number up, $5 million, right? The next round, There might be someone coming in to lead the round at $5 million, and then we put in 3 more, right? So that's the good scenario, is someone just dying to invest more money in you because you're blowing up, and like, who doesn't want to be in that company, right? On the other hand, you want someone who has reserve funds for if you run out of money a little bit earlier and you just have a couple more months that you want to get stuff done before going out to your raise. You want a set of investors that will help you get there, right? So maybe they'll put in an extra $300,000 to support you. And people call that a bridge round, to kind of bridge you to the next raise. You want someone who's able to kind of support companies in the down round or up round too. So very unlikely that someone's going to lead like multiple rounds, but having a little extra cash in the bank is not a bad thing. Yep.
I'm going to try and make a long question short.
Okay.
And I'm going to preface it by saying I do business presentation skills consulting.
Okay.
That's going to help you answer this question, I think. You've used the term slide deck. Okay. Everybody in this room has just watched you do a very effective, clean, simple set of slides with animation. If you handed any one of us those slides coming in, we wouldn't have learned nearly as much as listening to what you say wrapped around it. Okay?
Mm-hmm.
Now I get to my question. When you, as a VC,
Mm-hmm.
are saying, I want a slide deck, and it's really good if I can see it in advance.
Yep.
You are asking, true or false, for something that is different. It's not the business plan, but you are looking for something that happens to be created in slides, but has enough words and charts and information that it can be read without a voice.
Correct.
And understood without a voice.
Yes. So there's 2 different kinds of pitches. If you think about pitches in general, there's kind of what I'm going to call demo day style pitches, where someone stands up for 2, 5, 10 minutes and explains what their company does. This is the kind of deck that would be. The pitch deck that you would send for a phone call is going to be a little bit different. That's let's get to the meat of my business in a way that's not going to bore someone by reading through 20 pages, right? And so yes, I think you hit the nail on the head. It's not a presentation deck; it is a information deck. It does break the rules of presentations and
But
how
an entrepreneur
PowerPoint.
needs both of them for these different
Yes,
purposes.
exactly. Yes, and the other thing is, it's great to send the deck ahead of time. If you are doing a pitch in front of people, you can always use this deck and then have your detailed deck in the appendix. That's a beautiful thing too, right? Give me the story, and then when I ask that question of, well, what is your this metric, or how do you think about this, or what does your team look like? You say, oh, well, let's go to slide 16, and you see the whole breakdown, right? So I think there's a way to kind of combine them, but you're exactly right. Like, this would give me nothing if you sent it ahead of time.
What about like a Prezi or something?
Prezis are hard because you can't necessarily pull that down and share it with everyone. So anything that's kept online is kind of a pain in the butt, to be honest. And no one's gonna like steal your idea if you pull down a PowerPoint deck, right? Everyone can take screenshots anyway.
It's just a little bit more interesting to watch.
So interesting to watch. So do it from the presentation, but don't send it to folks. I think Prezis are kind of fun, and they're still novel right now. So people are like, does everyone know what a Prezi is? Okay.
It's an
So-
animated presentation.
Prezi is like, if you picture the presentation I just had on like a map, you can drill into different slides, and then it'll like zoom around to different graphics. So it's just a more interactive way of doing PowerPoint.
How do you spell that?
P-R-E-Z-I.
Yep.
I'm sorry.
P-R-E-Z-I.
Yep.
I'm making a pitch, the domains match, and the idea is good, but what are some common mistakes that entrepreneurs make that turns off VCs like you?
Okay. That's a good question. if the domain matches, so I think sometimes talking without ever taking a breath is a difficult. It's difficult to be on the other side of it, and so that can be bad for one of two ways. Either I have a question and you won't let me get in there, so like I can't, I'm still stuck here and you're already there, or I already know all this other stuff you're telling me, so let's just skip to your business, right? If people are combative with questions, that's also kind of a turnoff. And these are kind of just general, like treating people well, but condescending folks are sometimes hard to deal, not sometimes, always hard to deal with, but sometimes hard to be polite around. I'm trying to think of what else we've seen. So some less general mistakes, but not being able to articulate your story is something that I think kills so many presentations, where like it takes so long for me to figure out what you're doing. And so the way to think about that is when you do a bunch of these pitches, you're going to see people get caught up around the same part in your storyline. And so after, say 3 or 4 of those, you have to step back and say, like, what's so confusing about my business and how do I make it less confusing? So there are some very good resources for how to build a pitch deck, but some of that story stuff can be very important for people who don't know the pain as well as you know it. And so whether that's just telling a story of the first customer use case of this was their problem, this is why we were the solution, and these are the results, and then getting into the meat of the business, kind of setting that stage is very helpful. The other way to set the stage is to talk about your background and your story and how you came up with the company. So if my big idea is a good-looking tennis shoe, right? Like a professional-looking tennis shoe. I'll be like, oh, well, I always wanted to wear tennis shoes to work, but I couldn't because it made me feel unprofessional, and my heels, they were uncomfortable when I was running around all the time. So I built this. I did all this market research. Everyone else had the same problem. We did these prototypes, and all of a sudden, everyone's buying these things up, and we can't keep enough inventory, so I'm raising money for that, right? Like, being able to tell that clear story so people understand why you have the business you have is a very powerful thing. And so kind of getting back to your original question of the big mistake people make is not being able to understand how to tell their story in an effective way.
I'm not going to my question now.
Okay, wait, I'm going to do one last, do we have a homework? Is that's the whole idea? Okay, so my homework, and then we'll transition into total Q&A. So a lot of you said that your entrepreneurs are working in the startup space. So one thing to think about is if you are even thinking about fundraising, understanding where you are in that map of how much cash do we need? Do we need capital? And is VC capital the right capital for us to take? Being very frank with yourself about that exercise. Is a loan better? Is your working capital such that you don't need VC? Or do you really need kind of this equity capital to really accelerate? Because it's expensive to give up parts of your company. So when you figure out where you land on that scale, start to build a target VC list. And so this can just be a handful, but look at, first local, then regional, and then if you need to go kind of national. Early stage, you're much more likely to find regional investors, and think about what stage and what sector they look at, and then if you want kind of this extra credit, who on the team would be the one that would be most interested in your product. And you can find that out by looking at what boards people sit on, what investments they've made, or kind of like general announcements through press and things like that. So that's it for the presentation. We'll do open Q&A. Am I over on time, or we're good? Okay. So how about it?
Well, like I said, is there an upstart charge for this to get connected with you all? And is it a nonprofit or a profit organization? And how long has it been in existence? And do you have competition? As well as, kind of what's your target market? I know you expressed a little bit, but.
Sure. So no fee to connect with VCs because in a most basic sense, entrepreneurs are the customers, right? Like our product is our capital and our value, and you are the one who is accepting that in exchange for equity. So no cost to talk to a VC, and if they're charging you, they're not someone you should be talking to. We are definitely a for-profit organization. There are nonprofit is hard. There are state-sponsored VCs that have a little bit different of an incentive structure, but the traditional VC is for-profit. We have been in existence since late, I think our first close was like December 31st, 2011. So 5 years. This last fund closed last July, so this fund has been open, or we've been investing out of it for longer, but closed about, 9 months ago, 8 months ago. The last question was what we focus on. Am I getting all of these? Our target market. So our target market is first B2B SaaS, so the large majority of software companies that are selling to businesses. We do some software companies selling to consumers, so individuals that would buy an app to manage their expenses or something like that. And then we do some of that marketplace investing. So if you think about an investment we did is called Dolly that connects people who can move large items from one place to another in a short period of time with people who need a couch to be picked up from Craigslist and delivered to their house. So that kind of marketplace. We do early stage companies, so that was that kind of like early revenue up through $3 million a year. And we focus on the Midwest and then some other geographies that are similar to that. So Toronto, Pittsburgh, Atlanta.
I'm sure you're online. I'm sure you're online. I could do a little bit more research. For
Yep.
your company.
So if you cover up my email, we're at hydeparkvp.com.
Thank you.
So you talked about sort of the monthly recurring revenue expectations before somebody comes to talk to you. Does that depend on the price point of the actual software product you're selling? So if I have one customer at $10,000, annual contract value, that's different than 100 at $100. Can you sort of talk about that a little bit for people who might have different price points?
Yeah. So we think about things. So let's kind of remove consumers right now from talking, because consumers do have recurring subscriptions, right? Like Netflix, whatever else. So let's talk about like SMBs, so small businesses up through enterprise. Obviously, to have the same amount of revenue, you need fewer enterprise customers than you do small and medium businesses. The actual kind of traction range isn't all that different for how we look at the company. So if you think about a company that is selling into landscapers, right? Their price is probably going to be $50 a month. Versus if you're selling into enterprise, it's going to be $100,000 a month. That next layer deeper. So, and let's just say everyone has $100,000 a month of revenue, even if you're selling to landscapers, which is probably the entire market. But let's just say that the next level deeper, the metrics you're going to focus on are completely different, right? So you're not really looking at churn on the enterprise contract, right? Because you would either have 0% churn or 100% churn if you lost that one customer. And so instead you look into more of the pipeline and the relationship with that customer, how the contract grew over time. There's a lot of those kind of questions. On the landscaper side, you're going to look at utilization and churn and, expanding the market, all those kinds of things. So that kind of like quick qualification metric is very similar. The next layer deeper, totally different diligence.
So you're looking at the combination of things, not just sort of a minimum benchmark of here's how much a company should have in revenue. It depends on a few factors.
Yeah. Oh, 100%. That revenue thing is more of a qualification of, are we looking at a $100,000 check?
Yeah.
And in that case, we're not doing as much diligence of, oh, are we going to step up and, you know, like lead this, like how, you know, kind of where do you fit in all of those things? Yeah.
You had said that there's a difference between state-sponsored VCs and non-state. Could you elaborate a little bit on that?
Yeah, so there are some economic development departments within states that invest in kind of their own venture capital groups. And the purpose of that is more for economic development in the state. And so some of those VCs might have mandates to invest, you know, 90% of their capital within that state. And so they're looking at companies a little bit differently, right? Versus if you are a purely economic venture fund, you're just trying to do the best you can so that you can raise another fund, right? So it's more the incentives can be different for the managers of those two funds, and the restrictions can be different. So like we have no legal restriction on just investing in Illinois or just investing in the Midwest. We invest in Toronto. Versus there are some VCs that accepted state money in other Midwest states, right, who are just investing in their state. And so how they source companies, how they invest can be different, and even the fund economics can be different.
Does the way you set up your business have an impact on how VCs would fund it or, you know, do business?
From like the
From an organization perspective.
Yeah, so yes, there are a couple examples of that. Tell me if I'm getting at where the question's going. The first is just purely size. If we raise a $100 million fund, we can probably operate the same way. If we raise a $1 billion fund, totally different. How our investment processes, how we make decisions, how quickly we make decisions would be vastly different for early stage and then someone who has $1 billion to put to work. The other side of things is kind of how you have the investment team, so kind of like partners and non-partners, right? So there are people, just like a law firm, right? There's people who own the firm and then people who support it and, you know, rise through. That can work out differently. So a firm that's all partners and has no supporting people, maybe they spend less time outbound sourcing and it's more network driven. Another thing could be people outside of the investment team. So we have people like Jackson who runs a lot of our marketing and then also supports a lot of our portfolio companies, right? And some people take that on to their investment team where they're doing both things. Some people don't really focus on that side, and some people have entire platform teams that will help companies with sales and marketing and branding and pricing and, you know, all of those, recruiting, even outsource engineering, all those kinds of things. So you have various different spectrums. A lot of it comes down to kind of how big your fund is, but there are differences in funds.
So
Yep.
the support that you provide, assuming you close on the fund, we're now, giving decisions. What kind of support you provide, you just described. What's the extent of the support you provide to each of these companies? Like, if I need marketing, then would you actually provide some free service, or will it just be some consulting and point us to somebody that we have to go and spend money? Or?
So if we talk in generalities, there are funds that do every spectrum of that. So there are people that will actually deploy people to your organization and help you. If we talk about Hyde Park specifically, there's typically one or two people that work closely with your team, and so they'll be able to give you kind of the strategic help that you need. From a Hyde Park kind of value add standpoint, we kind of have like two things that we focus on, and one is go-to-market strategy, and then the other is helping companies placing really great talent with our portfolio companies. So if you need a VP engineering, being able to help find those people and place them in the organization. And different people have different value adds and sizes of teams and all of those kind of things.
Potential leads for that business.
Potential, like customer intros? Yep.
Lead generation.
Yeah, a lot of companies actually do that where they'll send out like, does anyone know this type of person in these types of companies? And then you quickly scan all of your connections and look for those intros. But that's also another way to leverage your investors. All right, that might be it then.
Yeah.
Any other
you did it,
questions?
girl.